Hello and welcome to another episode of Fractional Impact. Today we're speaking to Philip Adsetts of Longbows Consulting, a financial strategist with decades of experience across banking, private equity, and financial consulting. We'll be talking about how founders can think more strategically about their financial decisions, what needs to change when a company begins preparing for a sale, how experienced financial leadership supports both growth and optionality, and a lot more. Philip, great to have you on. Would you like to introduce yourself?
Thank you, Stuart. Happy to be here. My name is Philip Adsetts. I am the principal of Longbows Consulting, and which is a fractional CFO financial consultant. My background is, as Stuart says, both in banking and in private equity. So I have a varied perspective on businesses.
Awesome. Well, let me dive right into that varied perspective, as you call it. How do your years across all of these different industries help you kind of shape how you assess a business early on?
Well, I think as having a varied background of different perspectives on a business. From my days in banking, I can bring a credit, more closer examination of the business, and from my private equity days, that gives me a perspective from the position of an investor in a business. And I think the combination of both of those will allow me to get a very quick sense of how the business is performing and what are the pressure points that we need to be focused on. It's also giving me a very broad view of different industries. So I've looked at companies from real estate to aerospace. And so I have a very varied experience.
Yeah. And I know that the main type of company that you typically work with at the moment is founder-led businesses. I'd be curious to know, when you first step into that type of company, what financial signals tell you where the real issues of the business may be?
Clearly, the first thing that we look at when we step into a business is the cash position. And that gives us a sense of what, partly timing, and also gives you a sense of where the flows are. What we find in a lot of smaller companies is that we also need to look very much at the financial record keeping. What does the owner know? Do they know where their revenue is coming from, where their profits are coming from, which products are delivering the profits? And so financial record keeping would be the next. But we're also looking at metrics in general and see what we find to be important to know about that business.
Yeah. If you find that cash position is typically the biggest indicator of where the issues might be, if I'm a founder and I'm listening to this and I'm thinking, well, I only really know my own company, and I don't really know necessarily what a good cash position is, what would you say might be the benchmark for your typical company that they should strive for?
Clearly, you need to have a degree of cushion in the cash position. I think that it varies from company to company as to what is the appropriate level of that cushion. But one of the things we do early in an assignment, early in when we're retained, is to focus on cash flow projections and see where the cash is coming from, and probably more importantly, where the cash is going, and be able to predict that those flows out into the future to make sure that there is adequate cash to maintain and grow the business.
Yeah. Yeah, it makes sense. I would assume a lot of the companies you step into, the founders will be incredibly strong and proficient operators, but they won't be financial specialists. How do you help them make better decisions without overwhelming them effectively?
That's very true, that most people who start businesses are experts in their field, and they have their strengths. It's rare that you find a founder whose strengths are in the finance side of the business. Yeah. And that's where we can come in, and in taking over that side of the business, then the founder is freed up to be able to focus where their strengths lie. If it's development, if it's out marketing, and give them time essentially to be able to focus there. One thing we do try and do is identify what would be the key metrics to understand the business and how it's performing. And we try and organize them into what we refer to as a dashboard. And so it really condenses the amount of information that the founder is looking at down to what is most important. And they can look at that on a weekly basis, on a monthly basis, whatever they feel we feel is appropriate. But really, I think it's to try and reduce somewhat the noise, get down to what really is the important feedback that is necessary to run the business and make sound financial decisions.
Yeah, interesting. And with what you're doing at Longbows Consulting, what size of company or what challenges could a company be facing that makes them the right fit to get the most out of your expertise? Because obviously you're not running a charity, there has to be some sort of revenue in the company already to make what you're doing worthy and able to create an ROI. What is kind of that sweet spot for you?
We are looking at businesses which probably have around $2 million of revenue up to $25 to $30 million of revenue. As you said, we do like to get paid. And so having that base of revenue allows for that. And it also gives us the room to be able to work with the founder to maximize that growth. Excuse me. But really, the upper limit of what the companies we deal with is really more dictated by what is the appropriate time for the company to hire a full-time CFO. And so essentially we're trying to grow the company, help the company grow to the point where we're put out of the contract.
Yeah. So would you say it's kind of let's say the 30 to 50 million mark that a full-time CFO would make sense, and so you working with companies in the 2 to 20 million is kind of the stepping stone to get them there effectively?
Exactly. The cost of a full-time CFO is substantial and hard to justify in a smaller business, whereas bringing on a fractional CFO at a lower cost and really devoting a certain amount of time to the company makes a lot more economic sense.
Yeah, of course. You've seen businesses operate through a lot of different economic conditions. What financial habits tend to hold up and do well across those different conditions?
You're certainly right there, Stuart, in terms of I have seen both boom and bust cycles on a number of occasions. And so what I find that helps most companies through that the tough times and through the boom times, because the boom times in a growing business presents its own different set of challenges, but financial discipline is really what helps. Being able to keeping a close eye on the cash, on the results, and an in-depth understanding of the information that you're receiving, and making well-founded decisions based on that sound financial analysis.
Because for more of a non-financial expert like myself, I think it can be easy to assume that all the challenges come around when it's a tough market, and then when it's a good market, well, it's easy. But from my experience anyway, from what I've seen, it can be that when things are going really well and you're very bullish and you want to, grow the company and take advantage of all the opportunities out there, it can take money to do that, and it can actually make cash really tight, and it creates, problems that no one really thought of. How often do you see that happening to companies that are initially doing really well and want to build on that success?
That is really, I would say, at least 40% of the time we're seeing companies in that position, that they're poised for growth, and what they don't realize is that growth is likely to tie up some of the cash that they have. And so predicting the cash flows out into the future and looking at different scenarios. Going back to the previous question, having different scenarios that look at different external factors allows the company to really develop contingency plans, so that if the worst case or something close to the worst case comes to be, then you've got a strategy that is already being thought through, and you're not having to make panicked decisions which on less than perfect information. And so part of what we do to help a company through different economic scenarios is doing that contingency planning and projections, different scenarios on the projections, so that we can talk and work out what is the appropriate response.
Yeah. Do you find that sometimes founders, when they're doing well, happen to make more emotionally driven financial decisions?
I would say that in both, I would say pretty much in both cases, doing well and not doing well are a lot of decisions are made with emotion, as opposed to a lot of thought behind them. And I think what leads to that can be partial financial information. A lot of times the finance function, the accounting part of the finance function is weak. Maybe the owner is doing it themselves, and when they get around to it.
Yeah.
And so decisions are made on less than perfect information and less than complete information. And so at that point, intuition, emotion becomes more important. Whereas if you can have numbers that you can be confident in, and you understand what it's telling you, then you can make much more informed decisions, which hopefully are better decisions and lead to the growth of the company.
Yeah. So how do companies get to a stage where they're doing millions in revenue, but their financial data is incorrect in any way? Is that sometimes just a matter of the accountants not doing their job, or something else not adding up?
I think it's, like I said, smaller companies, maybe the founder is the one doing the bookkeeping, and so it becomes not a priority for them. But as they grow, maybe the procedures aren't in place to the degree they should be, or maybe they're not followed to the degree they should be, which can lead to incomplete or incorrect information.
Yeah, interesting. What are the most common blind spots you see in otherwise very successful small companies?
I think the blind spots we see most often are a lack of financial planning, and the lack and a discounting of the value of financial planning. And that leads to a lack of visibility and a lack of being able to project forward what the business can do in the next few months. Excuse me. I think another area is a lack of detailed knowledge as to where the profits of the business are really coming from. Are they coming from a broad range of products, or is one product carrying the rest? And so that can lead to maybe growing the wrong part of the business. The knowledge of where the profits are generated is critical. And the one other blind spot I think a lot of companies can founders can really fall into is discounting the message that a high degree of customer concentration is telling you. A lot of companies, maybe the founder has a great relationship with that client, and so believes that client is going to stay there and continue to be a customer. But I think you have to take a more skeptical view. Yeah. And say, okay, what would happen and what would we do if that customer either went away or cut back or split its business with a competitor. And so I think founders can discount the issue of customer concentration.
Yeah, interesting. When if you do go into a company and realize that maybe the vast majority of their profit is coming from a certain product or service, do you typically advise that they double down on that or try and diversify a little bit more? Or do you have a typical kind of decision-making framework, I guess, for what to do in those situations?
Again, it's somewhat situation specific. It depends on what is the suite of products the company has. If it's relatively narrow, then maybe you look to focus more on that, but also work on the bringing up the profitability of the other products. If there's a much broader suite of products, then I think you could spend more time, devote more of the time to some of the other products, which maybe not quite as profitable, but with focus can be more important in terms of generating the profits of the company.
Yeah, yeah, of course. For founders who feel quite stretched thin, where do you find that focused financial strategy creates the fastest relief?
I think the primary point of stress for most owners is, as I mentioned, the cash flow. That's where the crises most often happen. And to be able to prepare detailed cash flow forecasts, when is the money coming in?
Yeah.
When is it, almost more importantly, when is it going out? And that can give peace of mind and reduce the stress of the founder. But I think that in and of itself can really calm the mind of the founder.
Yeah. Cool. Well, I'd be interested to go a bit deeper into how you help companies coming up to that exit stage. When you are speaking to a founder that says they want to exit in the next 2 or 3 years, let's say, what are typically the first things that need attention, maybe sooner than they expect?
when we take on an assignment like that, the first thing we would do is basically conduct the due diligence as a buyer would, because that will bring to the fore red flags that a buyer may see, and so by doing that exercise, which is something we do frequently for buyers as well, it allows you to focus on the quality of earnings, a detailed analysis of profits, and also how much reliance you can put on the financial reporting. How good is the financial reporting function within the company? If the owner is looking for that exit in a couple of years, you really need to start looking at the business as if you were the buyer, and try and find ways to de-risk the business. Maybe we would look at whether the company is running any personal expenses of the founder through the company. And another aspect, a non-financial aspect, is how does the business owner want to proceed? Are they going to stick around and continue to run the business even if there's a private equity buyer comes in, or are they looking to exit completely? And in actually either case, you need to make sure that the dependence on the owner is reduced, and that the management team below the owner has the capacity to be able to run and grow the business. And this actually is one of the places where Jean, my partner, she has experience as a business coach, and she can work with both the owner and the other management to really try and reduce the impact of the exit of the owner.
Yeah. Do you and Jean typically recommend to founders to offer some sort of earnout? Does that increase their valuation usually?
An earnout, it can, because obviously part of the compensation, part of the purchase price, then becomes dependent on the results of the business. So again, you're de-risking it for the buyer. So it's possible to get a higher multiple structuring a transaction that way, rather than a single payout and the owner moves out of the business.
Yeah, because my thought would be that with an earnout, there's less risk for the acquiring company, and so less risk would surely result in a higher valuation. That would be my thought, at least. But
yeah, no, absolutely. That is correct. By making part of the purchase price performance related, then you are reducing the risk for the buyer, and they can, by reducing that risk, they can earn their returns with with a higher multiple.
Yeah, totally. In your due diligence work, what types of financial issues most often surprise business owners?
I think the ones that jump out when you are issues of quality of earnings, customer concentration, where the business is, how much reliance you can put on the numbers themselves, and but also running personal expenses through the business can be a red flag. One transaction I worked on a few years ago, we were looking at a business, and the business had 3 warehouses, and this business did not need 3 warehouses. And so in our due diligence, we discovered that 2 of the warehouses were used to house the owner's classic car collection. And,
Wow.
and he had been running those expenses through the business and deducting them, obviously as legitimate business expenses. But you also see that in the case of relatives being employed, all of those sorts of things I've seen in my career.
Yeah, I can imagine. What do you mean by quality of earnings? Because that's not a phrase that I'm familiar with.
Quality of earnings is really how repeatable are those earnings? Are they? Is it dependent on, say, as we've been talking about, a single product? Are there one-time items that boosted the profits in a year? You're looking at how repeatable are those expenses, and are they a strong base upon which to build and grow the business, because that's what a buyer is looking to do, is to grow the business, grow the cash flow from the business. So they want to be certain that the earnings upon which they are determining the price is a solid base from which to work.
Yeah, makes sense. When you're working with a company on the selling side, and you're doing your own due diligence, and you come across, okay, there's maybe quite a lot of earnings that aren't repeatable. Obviously, the acquiring company is going to see this, and it's probably going to bring their offer down a little bit. Is there anything that you can do or the founder can do to almost fix that in any way, or do you just have to accept that it's going to result in a lower valuation than the founder might have liked?
I think that what you need to do is, to a degree, be upfront about it. That you can identify those events and isolate them from what is the underlying results from the business. I think by doing that, you give the potential buyer a degree of comfort that you're being upfront. You're not trying to hide the result, the issues in the business, and it may well be that it results in a diminishment, probably more of the EBITDA of the business, and so the multiple may not change, but the core EBITDA of the business upon which you value the business, buyer will value the business, is probably going to be a little lower than it would otherwise be.
Makes sense. Yeah, interesting. Cool. Interesting. Yeah. Because I think sometimes you see EBITDA calculations that don't take into account anything like that as well. I've certainly seen occasions where someone will say, okay, our revenue is this, so our EBITDA is this, but they don't take into account things like that, as you said, can make a huge difference, especially if it's a higher multiple. I guess the higher the multiple, the bigger the difference the EBITDA will make as well.
And I think you have to view it that a sophisticated buyer, a private equity buyer, a larger company that's trying to fold your business into their business, will probably discover that.
Yeah.
And again, by being upfront about it, I think that they can then put more faith in the quality of the numbers that you're actually reporting.
Yeah, I guess it sort of builds rapport and trust as well. So I know that that's a huge component of these types of acquisitions. Yeah, that's a good point. What financial metrics do small business owners often focus on that don't actually help them grow or prepare for an exit?
The one we come across most often is that founders, small business owners, will focus on the top line revenue growth. But that can mask any number of problems. The margins may be shrinking. It may well be that the business is growing, but the cash side of the business, the cash flow, is being tied up. We would suggest that the founder and the owner focus on that EBITDA number as opposed to the top line revenue, because that is going to really be what determines the price. And so focusing on not just what is coming in, but focusing also on what is going out, and the net between the two is more important, I think, than most founders tend to get caught up in the growing the business and focusing on that top line revenue.
Yeah, sounds like it. Yeah. How early should owners start adjusting how they run the business if a transition or a sale is on the horizon?
We would suggest at least a 2-year runway to a sale. That allows not only the appropriate measures to be implemented, but also the results of those actions can begin to flow to the bottom line. And so giving an advisor some time to be able to analyze and suggest changes, work with the owner to implement those changes, can can result in a higher price, because you can be reporting a higher level of profits. So I think giving us a couple of years to help you can result in a more advantageous price.
Yeah. Cool. How do you help companies move from reacting to financial issues to operating with a clear plan?
We work very closely, clearly, with the owner to develop a forward-looking financial strategy with detailed projections and, as I referred to earlier, multiple scenarios. That allows the management to really give thought, and almost forces the management to give thought to what happens in different scenarios, and again, what actions should be taken should those come to pass. And so really getting away from the reactive decision making, but making the decisions based on sound numbers, on sound principles, but also having those contingency plans to be put in place, so that, as we referred to earlier, decisions aren't made on a panic basis. They're made with solid data to support them.
Yeah. Cool. Well, got one more question for you. You've helped secure non-dilutive funding before, such as grants. How should founders think about funding strategy beyond just purely equity?
The area of grants that we've had most success in is in climate, and what the availability of grants in that area is very strong, because a lot of the states and previously the federal government was focused on growing that sector of the economy. And so it really depends on what is the nature of your business, and how closely does that tie into public policy, to see if you can get government grants. There are also grants available from foundations. Again, you need to find the foundation that is focused on the problem that you're addressing, and we have a good level of visibility into those foundations. Smaller businesses, there in some communities, there are community loan banks that are looking to invest and put money behind businesses that can bring employment and revenue into the community. So all of those are non-dilutive, because the community loan boards, as the name suggests, are going to be making loans. But the other ways of doing that, you could find another business that is looking to grow in a similar area and leverage resources together to be able to achieve volume discounts on purchases and drive revenue that way. But working on those grant applications is a very specialized area, and we can certainly help you in those areas.
Awesome. Well, for anyone looking to get in touch with yourself and take advantage of some of your knowledge and insights, how are they best to reach you?
I think the first step would be to send us an email, and my email is up on the screen right now, and also the email of my partner Gene. So sending one of us an email, and from there we would go to set up a call with you to really get a sense of what you need, and where the overlap is with what we can provide. And so really the first step would be to send us an email, and we can set up a time to get a much more detailed conversation.
Awesome. Cool. Well, thanks again, Philip, for taking the time to join me today, and to the viewers and the listeners, thanks for joining us, and we'll see you in the next episode of Fractional Impact.
Thank you very much, Stuart.